If you're thinking about raising funds for your startup, one of the first questions you might be asking yourself is, what's your company worth right now? Because that determines the dilution that you're going to experience. But how in the world do you get that if you don't even have any revenue? How do you calculate that valuation? Well, I'm going to pull back the curtain and explain to you how investors look at valuing your startup. Greetings, founders. Welcome to Feel the Boot, the science of startups. I'm your host, Lance Cottrell, and I'm here to help you navigate the process of creating, building, and growing your startup. I know how difficult it is, I've been there, and I've helped countless other founders through the process. Now, mature or public companies are often valued based on their revenues or earnings. Right? You'll often see this company's stock is valued at X times earnings. But that obviously doesn't work when you're an early stage startup, when you have little or no revenue whatsoever, and you're probably losing money, so you certainly don't have any earnings. How can you then get at what your company is worth right now? There are a couple of common valuation methodologies, and I'm going to walk through each of those before I share the secret behind what's really going on. So in the absence of revenue or earnings, how are you supposed to get at some kind of valuation? Well, there's a lot of other factors that investors can look at, one of which is traction. How are you doing at getting interest from customers and creating a waiting list or other proxies before you get that revenue? The next factor is your team. Who do you have in the company right now? And do you have the experience and skill sets that will allow you to execute on your plan successfully? How mature is your solution? Do you just have a wireframe or prototype? Have you built your MVP? Are you all the way to the full 1.0 version of your product? The more baked it is, the less risk that the investor takes on, the higher your valuation will be. They can also look at the financials around your business. While your business itself may not have much in the way of financials, they can look at what's the opportunity, how big is this market, and understand where you could get the business eventually, so they have a sense of where your exit might be. One methodology is called the Berkus method. And in this case, you take a look at a number of factors that will affect the company's valuation and give them a weighting of up to $500,000. There are 5 factors, so the highest valuation you can have with this methodology is $2.5 million. And so to each one of the categories, you're going to say this is a really good company, it gets the full $500,000, or they're a little weak in this area, maybe they get only $250,000 or $100,000 if the things are really not looking good. So the factors are, is it a sound idea? Does this actually make sense as a business? Do you have a prototype, and how robust is the product that you're building? Do you have a quality management team? People with experience in the space, experience running companies, maybe even prior startup experience. That'll go a long ways to earning that top $500,000. Do you have strategic relationships with other entities, people who can help be channel partners to help you sell, to help with manufacturing or other aspects of your business? A robust set of partners can take you a long way down the road. Finally, how are you doing with your product rollout or sales? Do you already have some traction? Do you have a waiting list? Things like that. So to each of those, you're going to go from $0 to $500,000 and then get a total valuation of $2.5 million. One of the problems with the Berkus method is $2.5 million is not a lot, right? That's really a pretty low number. So I'm not seeing that used too heavily, but for very early stage companies, you still sometimes hear people talking about it. Another valuation methodology is called the scorecard method. In this case, you take some other company that's had investment and use that as a reference. So you say, if this other company was valued at $3 million, and they're generally at the same kind of stage, same kind of space, same kind of market that you're in, let's take a look at you and compare you to that other reference company. And we do that on a number of different aspects. Each one is weighted separately. So we say, you're actually 50% better than that company in this area, but 20% worse in this other one. And so the factors are strength of the management team, and that's worth 30% of this variation. How big is the opportunity? What's the size of the opportunity? Is this a $1 billion market or a $100 billion market? Your product or your technology. How mature is it? How sophisticated is it? How needed is it? What's the competitive environment? Are you going into a really crowded space where there's dozens of other companies all vying for your customers? Or is it more of a greenfield kind of opportunity? Do you have marketing or sales channels or partnerships? Those are also weighted. That's at about 10%. Will you need additional investment, and how much? Is this the only round you're going to need, or are you going to need round after round after round? That's all weighted at 5%. And then there's a catch-all category, other. So anything else that I as an investor look at and say, wow, that kind of makes you look better than other companies, or that kind of makes you look worse, that gets another 5%. And so I just add up the factors. This is 1.5 times, this is 0.75, this is this, multiply them by the percentage weight, and then I get a number. Let's say at the end of the day, you are 125% as good as the other company using this methodology. Therefore, your valuation should be 125% of that other company's valuation. While a little less common with angels, venture capitalists will often use a methodology directly targeting the returns that they want to get. So they basically look at, where do I think your company is going to exit if you really successfully execute on your plan? Think about how much dilution they're likely to get over the next rounds based on the amount of money they think you're going to need, and then just back into the valuation that gives them the returns that they're expecting, say 20 times. And that's the valuation they're going to give you. So it really says nothing about your business. They're really only saying, we're going to bet on your ability to have this home run exit. And if you don't get there, I really don't care. We're going to consider you a total failure, even if you have a modest return. So if you hit the home run, then we get the returns we need. Therefore, that backs into the number they give you. Sometimes you'll see people using a method called risk factor summation. And that's really kind of a hybrid of the Berkus method and the scorecard method. And if you do some research, you'll see there's a lot of others out there that are typically small variations on these basic patterns. Now, before I get to the secret valuation methodology, I'd like to ask you for a favor. Please like this episode. It'll tell the algorithm that this is the kind of content you want to see more of, and it will help expose this episode to more founders. That's the whole reason I'm doing this, trying to help as many people as I can. Thanks. The dirty secret is that I think few angels actually use any of these valuation methodologies. We tend to go by gut and instinct based on our experience. We see tons and tons of deals and lots of valuations. And so we pretty quickly get a feel for, in this space, at this stage, with this team, this is about the kind of valuations that we see other companies getting. And so in a couple of minutes, I can glance at a deck, have a quick conversation with the founder, check the direction of the wind, and give you a number. And that seems to be the way most of the people I know actually do it. Now, if you challenge them on the number and say, why is this the valuation, or I think I want a different valuation, they may go use one of these methodologies to explain why they're giving you this number. But the reality is, all they're doing is justifying the answer that they already gave you. So they're using these methodologies like a drunk uses a lamppost, more for support than for illumination. At the end of the day, your company's valuation is what you can get people to pay for it. So there's always an aspect of negotiation with these things where you're trying to make the case that your company is worth a little bit more. The other angels may be trying to make an argument that the valuation should be a little bit lower. You're going to end up coming to some compromise. And sometimes you'll be able to get a valuation that's really very high, much higher than probably you deserve. And while that feels like a big win, right? Everyone would like to have that higher valuation. It can in fact really bite you later. So be careful about getting an early valuation that's too far out of line, because it can make it much harder to motivate employees and bring in the next round of investment if you need it. Thanks for watching this episode. I hope you found it useful and interesting, and if so, please like, subscribe, and ring that bell. Make sure you'll get alerted to each one of the new episodes I release, and it really helps the channel. If you're interested in getting one-on-one coaching for your startup, go to Field the Boot and sign up for our mailing list. With each email, I include a link that lets you sign up for my office hours, and I'm happy to work with you on any issue that your startup may be encountering. If you'd like to meet other founders and bounce ideas off them, join our community, the Feel the Boot Founders Alliance. On Facebook, I'll put a link to all those things down in the description. Until next time, ciao.